Welcome to the Flex Uncensored podcast. Gio will tell us where he's zooming in from momentarily. We are here with a repeat guest, Michael Kloppenburg, Vice President at Avison Young, and longtime co-working guy. You've been in the business for a long time, so we love having you on the podcast. Thank you for jumping in with us today.
Thank you. Thanks for having me. And I'm happy to be a repeat guest.
Yeah, there aren't that many, so you're one of a select few. Gio, tell us where you are today. You might have to flip your video off again. Yeah, you're stuck. There we go.
I am in Johannesburg, South Africa. And so
Okay.
I am calling in from Johannesburg, South Africa, and I am here to go on some fun safari stuff. And if you're anti-hunting, I will not be shooting anything. If you're pro-hunting, I will be posting pictures. But, the last couple of days have been here in Joburg, and it's been awesome just to see the culture and spend time with some business people and understand how they use co-working. And then tomorrow I actually head out into the bush, so about 4 hours away, and then I'll be out there for taking in nature.
Yeah, this is a bucket list trip. And then what are you doing after this?
I am flying to Australia, to Brisbane.
You thought it was on the way.
To do the keynote for, yeah, exactly. And so, I'll be doing the keynote for the Flex Workspace Association in Brisbane for Australia. And then I'm going to fly over to Sydney and spend some time with Brad and some of his team. And then I'm going to get to go to Melbourne and see Toby and all the great stuff that they've got over there. So it is a whirlwind of a few weeks.
Yes, that is incredible. Okay, for those listening who don't know who Brad and Toby are, Brad is the CEO of The Hub Australia, and Toby Scovron is the CEO of Creative Cubes. They come to a lot of the
Both
conferences.
awesome brand.
Yeah, 100%. Okay, so let's talk about what's going on in the world of brokerage today. I took the day off from LinkedIn, and Michael Kloppenburg said that there has been some exciting news released by the major brokerages that things are looking up, which really quite surprises me. I haven't been tracking that very well, and this is office, like what's driving. So you said CBRE might have had their best second quarter ever. What's driving that? What's happening? Give us the highlights, Michael.
Well, it is, I believe, the way that they framed it, what the article was framed was that let's just say the top 5 publicly traded brokerages, CBRE, JLL, Cushman, Newmark, Colliers, are all having positive years with respect to years past and are all raising outlook and guidance for the rest of 2025 and a lot of positive sentiment into 2026. These are public companies. They have to give public statements. Thankfully, they also have to report financials. And so we can look at those and compare that against what's being stated and make sure that it is, in fact, positive news. But I think it's not just office, for sure. I think that would include sales, and not just office leasing. That would include sales of office buildings, sales of industrial buildings, project and property management. It's basically all service lines, I think, are headed in the right direction. I'm sure there's nuance to that, but the global statement is that brokerages have a positive outlook on the rest of 2025, and I think that would bleed into 2026. And at Avison Young, we're not public. We don't have to give such statements. We don't report earnings, but we did publish a sentiment internal survey with like 200 or 300 brokers that went through a series of questions. What do you think about the second half of the year in terms of pricing, leasing velocity, return to work stats, things of that nature. And I think it's either neutral or to the good in almost every category. So that's good news for all of us in the commercial real estate industry, that the people that are touching the service lines across the industry have a positive outlook for the rest of the year. And I think internally at Avison Young, there's still rough patches in certain markets, and certain service lines aren't as successful as others currently, but general optimism is coming up. And is Gio raising his hand?
Yeah, I'm doing that so that since I've got a lag, I don't sit here and cut you off or vice versa. So I'm getting creative. So I had to find that feature. But yeah, back to your point. So Jamie Hadari posted 7 hours ago, and he basically, I'll summarize it. Employers and employees seem to finally be on the cusp of a great compromise. And he talks about hybrid and all that stuff, but then he goes down. But compared to even a couple of years ago, 72% of employers say they're achieving their workplace expectations, and employees feeling pretty good about it in a workplace. And so then he breaks down by, percentages. So those are pretty incredible stats. And we've really seen, if you've seen, I don't think either one of y'all have seen Brandon Madero's latest presentation. He did that at ULI for us a couple months ago, and he's going to be doing it at GWA to kind of talk about the utilization for some of the companies, large landlords and enterprise users that he's been working with. But that's pretty on track for what he's seen is those, not only those dates, but also as you look at the week, Tuesday, Wednesday, Thursday seem to be heavier, with Wednesday being the heaviest. And so it's really interesting. Monday and Friday, people are still kind of doing that bridge and doing a longer weekend and working from home. And obviously they're still working, but it seems to be they're not eager to get into the office on Mondays and Fridays. So I thought those were interesting.
And that's all,
stats.
by the way, that's probably not in their quarterly reports, but that is their annual occupier sentiment survey, which is really well put together. And there are some sections on Flex that are worth reviewing. So I think you can just go online, download it, and you can see Jamie's comments, and it's spurred some other industry folks to respond. A lot of people follow Jamie, so he has a platform. And I think you mentioned Brandon's work, and be really interested to compare his views on what CBRE is, calling navigating the peaks and valleys of office attendance, because I know that's a big part of what Brandon evaluates and part of his recalibrate program. So yeah, there's a ton of good data. And because CBRE is the biggest in the world, they have access to tremendous amount of customers. So they segment it by large, medium, small. They've got respondents from each of those categories. They dissect the data in a lot of different ways. So it's a really complete way to view what they believe are the important things worth of researching. Many of the brokerage firms have these things, but this is one of the bigger ones, and they obviously have the resources to put it together in a really, really complete and professional way. So it's a competitor, but it is a very worthy one and worth the read if you have time. It's about 30 pages, but it's slides, so it's easy to get through.
Oh yeah. I'll put the link in the show notes just for anybody who wants to take a peek.
And you can put the link to our internal survey as well. I'll send you that.
Yeah. Love it. Okay, great.
Look at you, company man.
Company
man.
I know.
I'm a company guy,
No,
Gio.
of
Come on, look at
course.
this. I'm in the
Love it.
office. I got a nice colored shirt on. But in any event, I think, what we're seeing and hearing at the brokerage level is office leasing is still challenged in certain markets. It's definitely up and back, as they say, in like New York, and there's really positive trends in San Francisco. Markets like Chicago are still really struggling, in my view. And I think according to the data, there is this overused phrase, flight to quality, to like the trophy assets. That is actually real. It's not, it doesn't mean that like every trophy asset is, absolutely full in every market. It just means that people are upgrading their space oftentimes as they downsize. So there is truly like a flight to quality, and that corresponds with flex space too. I think, the better the space, the more attractive it is to the end user. Currently, in order to get 20 seat requirements, you're going to have to really support a 20 seat group. You can't just put 20 people in 10 private offices. So there's like there's a flight to quality across the board, but I don't think that means like office leasing is back in every which way. I think it just means that a lot of the biggest companies with the most capital to spend on real estate are choosing to upgrade their space.
Yeah.
And I just I think
Well, I
we
think
just had some data recently that now that that upper tier is really filling up, it's now positively benefiting the next tier down. So there's a trickle down effect because you may not be able to pay $80 a foot, but you still want the best. In the last 5 years, most landlords in the B to A categories have been investing millions and millions, tens of millions in their buildings to make them more attractive. So I think trophy is always going to be successful. Beneath that, the A, that maybe were the trophy 10 years ago, those are now the benefactors of this flight to quality. And I think what we still worry about really, and what we're seeing a lot of conversions are these fully functionally obsolete and antiquated office buildings that need to be redeveloped or reimagined. Highest and best use is no longer office. It's residential, it's data centers, it's parking. I mean, in Charleston, like, I got put a parking garage downtown if you can. Like, that's a good investment. So you think about the highest and best use of real estate, it's not always office. And so I think that'll continue to right size over the next cycle as old antiquated office moves out, new office comes in, or new town centers and old suburban parks that need to be bulldozed. I think there's going to be another cycle, and it'll probably 10 to 15 years of change. But I think we're maybe the moral of the story is we're probably heading into the new cycle. We're out of the trough, and we're probably into a new. It'll vibrate, but it's going up.
Gio, hand raised.
Yeah, yes, thank you. Part of what I wanted to jump into with you is, you're doing deals kind of across the country in various markets, several operators, kind of what environment are you seeing out there as you have conversations with landlords, with brokers, other operators within the space, and where are landlords currently in those environments? And then how about brokers?
So yeah, you're right. I'm looking all over the US for a variety of clients, small markets, large markets. What I'm most interested in and what I've spent the majority of this year focused on are really secondary markets and tertiary markets. So think like Columbus, Ohio, Indianapolis, Orlando, Louisville. I don't think Phoenix is that, but Phoenix is probably the largest of that second tier category. Vegas, Bentonville. So I've been thinking a lot about smaller growth markets where the supply and demand dynamics for our business, for Flex, are more in the favor of the operator than maybe a downtown San Francisco where there's a tremendous millions of feet of Flex space. So, on behalf of operators, I am looking in some of these secondary markets where perhaps the only operator is Regus, and there is good population growth, and the demand metrics are positive. And by the way, the rents are lower, so it's easier to be profitable, assuming you can, capture the adequate demand necessary to be profitable. So, like, a lot of what we're doing now is looking at markets where there is a supply and demand imbalance and trying to find good opportunities for operators, a few in particular, that can compete in those markets and will go head to head with Regus and likely take from that market share, or, maybe there's plenty to go around and Regus will still be successful. But in most of these smaller markets, what we come across is almost only Regus and mom and pops. And then you've got the regional players who occasionally will have a great center or two in a city. And you've got Cohatch, who's all over the Midwest and in Florida, doing this in a very great way. But I think those smaller markets is where I've spent a lot of time. Owners in general, still a lot of them are in a capital crunch, or they're dealing with a lender issue. There's a lot of shadow vacancy, if you will, like a lot of buildings that just can't transact. And so we got to avoid those. So there's a whole new layer of research that has to go into trying to place an operator in a building, is whether or not that building can actually perform. That's unfortunately systemic. I think a lot of people, lenders are taking back buildings. I've had a call with a lender this week that is considering taking back a building that has a co-working space in it. And what do they do with that? Should they sell the building? Should they do something else? There's just, landlords, lenders, the capital side of ownership are all still dealing with challenges. And then, brokers, their product is the office. So I think what I see is brokers focusing on the buildings where they can transact. If they can't, I think they've dealt with that with their landlord partners and saying, like, when I call them, they're like, listen, we don't have TI. These are as is deals or no deals. Like, okay, well, can we do that? Probably not. We'll move on. So I think brokers are still on the landlord side, emphasizing the buildings where there's still the ability to transact, where there's still capital for tenant improvements, where they can still pay commissions on time. That's another thing. Like, commissions are not as automatic as they should be. That's something that we have to chase down more than I'd like to admit. Gio, probably you experienced that some, but it's all tied to this capital crunch, and it's thereby tied to, I think, what happened with the interest rates. And now a lot of these buildings are still underwater because they can't refinance in their current situations. So and so when we talk about positive sentiment, the backdrop is a lot of that's still going on. So we'd have to parse through the biggest brokerages reports that they publicly put out to figure out where is all of that coming from. Is it data centers? Is it the service business, like property management? I'm sure that props up these businesses, but leasing is definitely improving. In the co-working world, we all know a lot of these deals are hybrids, or they want to be management agreements. And Kane talked a lot about that on the Ask Me Anything for GWA last week or 2 weeks ago. They're really hard to get done. He doesn't do them. Flip doesn't do them. Interact doesn't do them. The people that are actually doing deals don't do those. I think Industrious, from what I just heard this afternoon, still doing like a hybrid, participating lease of some kind, but they're paying more than 50% of market rent. And so to me, that's a lease. It's certainly nowhere near a management agreement. So when we go into a market and we start talking about management agreements, that's a whole nother discussion. Still possible, still part of what I think the future of co-working looks like. But in the current environment, in my experience, the deals that are getting done in that space, the management agreement to JV revenue share, that area of the deal structure spectrum is occurring with landlords that are either flush with capital and they're like willing to take a risk, they believe in it, or they're desperate and they're dealing with a problem and they're like, if you can do better than the last guy, I'll give it to you. Or if you can fill this law firm space and I only have to put $10 in it, we'll take a flyer on your business, but we're going to kick you out in 3 years if you're not doing what you say. So there's still this, what goes in co-working deals and what traditional leasing looks like, still pretty far apart in terms of landlord expectations and operator expectations. So what I've seen over the last few years is that the deals that are getting done are in the lease category, or at least minimum rent leases versus pure play management deals, but they're still getting done. We did one last year with Mike Creel, very proud of that deal, but they're just really difficult. And brokers avoid them because they don't know how they're going to get paid. They don't know, there's no guaranteed rent. There's not a framework for this. And I deal with that internally a lot. And Jamie, we have a flex fluency program where we try to educate our internal brokers on all things flex. And that's a subject, what are management agreements? How do we structure them? How do we get paid on them? So yeah, there's a lot there to unpack.
Yeah, I think it's really challenging to get to the finish line on those deals because from what I've seen, even landlords that are like, you think really get it and they understand the synergies to putting flex in a, development or an asset. It's like when you get down to the cost of the build out and we see this like flight to quality need, which means the cost of build outs are not getting any less expensive. It's just a real hurdle to your point. It's like just a kind of a storm of factors, access to capital, the flight to quality, and getting those over the line. And
one other thing, as leasing improves, it makes it less likely to do this.
Totally. Because I think along the entire journey, the asset owner is just waiting for a lease to show up, even if they seem to really believe in the advantages of having flex in an asset. And to your point, the brokers, I mean, I've seen some where they're like, no problem, we'll just do the equivalent of market rent essentially for the structure for the brokers, and there's a market rent hurdle in there, and it works. But I don't know that that's widespread yet. So yeah, it's helpful to hear that perspective. Gio's got his hand up again.
Well, while we have him on applause, I had a call, and I mentioned New York is most likely turning the corner in a big way, and New York is a very busy leasing market right now. I had a broker tell me we might have considered that 2 years ago, but that ship had sailed. Like, we're getting tremendous in terms of an alternative structure.
Yeah.
We're getting way more than we would have gotten on a traditional lease basis. Currently, we've got multiple offers. We've got bidding wars on space. Some of that's not exactly. I don't trust.
Yeah.
I don't trust all of that, but there's enough data to support that. I believe in most cases, what maybe you could have done a management deal on 2 years ago is no longer an opportunity.
Well, I think I'm sorry I cut out. So if I'm repeating something y'all already said, but I mean, I think part of it's frustrating on my end that we're still this far into these conversations and still people are confused about what a management deal is, right? And we still continue to use a management deal as opposed to non-traditional deal structure or JV or some other conversation, right? Because to your point, there's very few management deals actually getting done, right? There's people showing up with capital, whether it be furniture, whether it be operating capital, all kinds of things. So I think that's part of the continued frustration that there is on understanding what it is, because people outside of our quote unquote bubble don't really understand it. And so I think that's a big issue that we've got with getting these deals done. And then back to the other point is then you got our good friends over at IWG mudding up the water with their structures, right? Where they don't even have real estate people chasing these deals. And so they don't even understand the real estate side of it. But then you also have people within the space that are trying to do these management deals. And now you've got, I heard you say the bidding war part. And yeah, you do have, IWG show up and then they start talking expansive or start talking to Workbox or start talking to whoever. I mean, even people that are looking to do traditional deals and they're like, well, this is what IWG said, or this is what this other group said. And, we're fighting against, I don't want to call it false information, but certainly I think it's skewed, over embellished pro formas that are being provided. So it makes it really difficult to have those conversations.
And landlords, are looking to people like us to help evaluate these proposals. So that's a part of the service we provide is, someone that's evaluating Regus, expansive, industrious, and car workplaces, may look to any one of us on this call to say, can you help me sort through this? I'm not comfortable in this. Everyone's telling me something slightly different. These agreements all look similar but different. None of it looks like a lease. I can only do a lease. How do we change the term? So like landlords require more support to make these decisions, especially if it's a departure from what they're used to. And their banks are going to require that too. So yes, Regus has gone to, I think every landlord in America has received a letter that their building is a good fit for their business model. And that has been a problem for me in some of these secondary markets where they've already run through every landlord and they've made their pitch, or they've had conversations that didn't go anywhere, or maybe someone that was successful. But I can tell by the time I've gotten to a new market that all of these landlords and developers have made a decision on the subject one way or another. And Regus has an army of people doing this work. So they've got a ton of scale, they've got a ton of reach. And so there's a lot of education from my standpoint to the opposing broker or the landlord's team to explain why maybe what Regus said was or wasn't accurate, or why TKO Suites is different than Regus, and all the reasons why they may want to go one direction or the other. So there's a lot more education required in placing an operator with a landlord than education required to put a law firm in a building. Like that is just math and underwriting credit. When you get into these other categories or shared economics, it's a much more complicated negotiation. It's a much more complicated sale when you're asking these people to invest in your business, basically. So it's tricky, but I do appreciate how hard Regis is pushing, and they are opening a lot of locations. They've been successful. And I think there's going to be a tail to that. I think in 3 years we'll see like how much.
I'm on that bandwagon. I'm shorting.
How much of this
about 3
push is
years.
going to last? You know, two of my colleagues worked for Regis for many years, and I mean they're very smart and they know about this business. They are deeply entrenched in flex, and they learned all of that at Regis, and I respect them deeply as colleagues today at Avison Young. But they have questions about this approach because they would have been the ones left managing it and selling it.
Right.
And
well, I think to your point, they've sort of flooded some supply in smaller markets, but it's not supply that will be profitable long term. So they're picking up demand, but I don't know that those locations are sustainable.
And when you think, you know, who's the tenant that they're going to acquire for that space? You know, that's really what it's about. Like you can build space, but you got to fill it up. And so there's got to be adequate demand for the space that you're opening.
Yeah, well, and the space has to be large enough to make the numbers work for the landlord to get any revenue from it. That's for me the short is I think there will be massive disappointment on behalf of the landlords who have 6,000 feet, 10, even 15 that on a the big rev share that they have in place, it just doesn't work. There's nothing left for the landlord on the model. So we shall see.
Well, that's where I will play my uncensored FU side of there's not an over under, right? I mean, it's definitely 85 to 90% of the spaces are going to fail. And it's just simply, they're too small. They haven't built them out. They're trying these, I love bare walls, but people aren't going to lease those offices to the level that they're trying to build them out. And I mean, I think that's part of the problem is even what you mentioned about your teammates, right? I think the world of them, I think they're great, but they're not real estate guys, right? They're great at the operational side of stuff. And I think that's the problem right now is the people that are pushing these IWG deals are incentivized to go find deals, right? And they're not necessarily good deals. And so I don't think there's anyone running the numbers to make these work. And the few internal IWG people that I do know that are running the numbers are currently unemployed because they've been let go when they said these spaces are never going to make money. And so I think, unfortunately, unfortunately, I think that this IWG circus, as I'll call it, is going to be the next big hickey for our industry to go with the one with WeWork that we had to explain why we're different from WeWork, right? And so, we're going to be looking at a deal that's down the street from the IWG that closed. And we're going to have to explain, look, it was 4,500 square feet with 12 offices and 35 cubicles and 20, 6-7 foot walls that were semi-private with Very, right? And so we're going to have to explain that hickey, if you will, just like we had to explain the WeWork one, because again, it's not one or two. I mean, they're opening up hundreds of, I think they're opening up a location a day or something crazy like that. And so I think it's great that they're pushing, but it's making it really, really difficult. And so I think, the big part for us is really continuing to understand why we're targeting locations, right? I mean, I said it over and over again, and I know, Michael, you and I have the conversation. Jamie, you and I it comes down to three things, right? It's the location, it's the deal structure, and it's the layout, right? And I think those are all three factors that we are all focused on advising our clients on, right? And, that's the important thing. And even then, there's times where even you would hear those three, but you miss the mark in some way, shape, or form. And we've seen it in markets right now. We're seeing it in Nashville, where everyone decided to all of a sudden open in Nashville, right? And so I think the brands that have opened are kind of lagging behind because all of a sudden, you've had this huge influx of supply in a market where there was definitely demand. But how do you work through that, right? And we've seen that happen in Phoenix and Columbus and, other markets that were sexy and, a bunch of people went to.
Yeah, well, and you mentioned Phoenix. I was a part of a takeover where former operator had leased hardly any offices, and in less than 6 months, the new operator is full. They got a better cost basis, and maybe they were charging a lot less, but they figured out what they needed to do to fill space, and they priced it accordingly. And once you have a full center, it's a lot easier to push pricing.
Yeah.
But it's like walking into an empty restaurant. If there's no one in the space, it's really hard to get those first few sales. And with respect to Regis and all the ones that they're opening, it's really up to those are partnerships. So it's up to the landlord to close them. And the landlord has to have a viable alternative to make that decision because, well, except for Regis has, their fees, I think there's going to be plenty that stay open that don't transition because there's
no
not
alternative.
another tenant behind looking to take 10,000 feet in the middle of, Knoxville, suburbs or something, wherever they're going. I think at least they're in partnership situations where landlords have some control and can terminate them if they're not performing versus being in a lease and dealing with litigation and default. And, but most of those landlords wouldn't have done those Regis deals if they had a better alternative. Like that's the elephant in the room is none of them want to do those deals, but they have to because they don't have good options.
I think that's a good conversation. Yeah, I think that's a good conversation. I mean, Jamie, you and I have all looked at those agreements, and I guess, I'll be honest, it's probably been 3 months since I looked at one, but none of them have termination agreements on the landlord side, right? Only Regis can terminate. Landlord does not have a right to terminate even for performance in a lot of these. And the landlord's just agreeing them to them because Regis is so big. Have you read or have you seen otherwise? One of you two?
I'm pretty sure that the ones that I've seen confidentially are there's a provision around performance.
Yeah. Well,
but I'm sure I'm sure there's differences in they're also, I think, and this better than most, but there's also the management agreement team and then still the corporate led team by Michael Beretta. They're different. Like they have different goals. And
they're all under Beretta now. Everyone's under Beretta. And they're not doing any new deals. They're signing renewals, right? But even the renewals, like I just got done doing one with trying to get an old Regis that their lease expired and actually became holdover because they were trying to get $10 below what the landlord wanted. And when I showed up with an LOI, they basically showed up and increased to the market rate and did the deal. So they're still doing the traditional renewals, but they're trying to avoid them, right? They're still trying to, find the best deal. And so I think that's part of it is the direction that everyone has gotten is that there are no capital expense deals. And that's their growth, right? They're not doing any more traditional new locations as of today. Will that change? I don't know. So I think it's going to be interesting just to see it play out. And back to your point, I think there's, depending on what the location is and what they think they can achieve, they might negotiate different deals. But I mean, I can tell you they're coming out of the gate with no termination. And part of it, the landlord doesn't want to keep running it because they're still having to feed it, right? They're not only just providing TI and capital to open these things, they're actually responsible for the operating capital. And so sometimes you're better off just letting space go dark. And you and I both know that for a traditional or management deal, sometimes you're just better off going dark than, continue to feed a failing business. And so I think that's interesting. And back to your, the space you picked up in Phoenix, I think that's another topic of conversation is we're seeing more and more of these operators that are bouncing out of their current territories, right? Whether it be states or cities. And, some of them just don't have the capacity. And not because they're not capable, it's just hard to market when you're based in California to all of a sudden market in Phoenix, or you're based in Dallas and you're opening up in Phoenix, Nashville, and Atlanta, right? We saw Common Desk try it And, people can argue whether they failed or not based off of experience, but he went from Texas to all of a sudden opening up in the Carolinas. Right. And so I just think there's brand value that some of these operators have, but most importantly to me, it's, the ability to market in a market that you're new to. And the other part is your team, right? Do you have the right sales team in place? Do you have a team that's going to go out there? Are you moving someone there? I mean, 25N has done that multiple times, right? As they find a really strong team member and they move them to open up new locations. And so, I'd be curious. I mean, you're doing work for operators that are opening up and I'll call it random locations. And I don't mean as in they're not in good locations, but they're not growing with a big market share, right? They're not opening 3 to 5 locations in market. They're just finding good locations and, finding success from that standpoint. I mean, how do you think, and this is for both of you, Jamie, because I mean, you advise on the operation side and as people grow and you have a lot of great conversations, but I mean, how are people overcoming that?
I think when the group I'm thinking of, we typically when we go to a new market, we wouldn't go there if there wasn't the potential for 2. So maybe that's an urban or downtown, depending on the size of the city, and then somewhere where there's a good pocket of demographics in the suburban neighborhoods. So like downtown Columbus, and then on the northern Polaris or something along those lines, like a good, strong submarket in Columbus. So we usually look at a couple of locations because I do believe there's scale. Opportunistically, there are people that will go anywhere for the right terms and will do their best to figure it out. I do think like Car Workplaces, they own the DC market. They've got 15 locations here. I know they've always, when they go to California or they go to another market, it's just not always the same. They have the same corporate services. They have the same ethos. They have the same mission, but it is usually different. When you've got corporate management and then local management, I think that sometimes creates issues. They do a good job of bringing people together and having manager meetings and things like that. It comes down to culture, but it is really hard to scale when you have a concentration in Dallas and all of a sudden you get an opportunity in Seattle. Like, you better be sure you can manage that and fund that, and you know how to hire and you know who to hire in that type of market. It's just, we're all these markets are very different and have different economic factors and demographics, and you can't replicate, in my opinion, you can't always replicate the same success you've had in your home market in satellite offices. So I do think you should have more than one if you're going to stay and do well. Just you get better scale. You can spread your sales across 2 centers. You can spread personnel basically is the biggest cost. You get economies on, and then maybe some buying power, in my opinion. But yeah, I typically wouldn't just put a random operator in a random building in a random city. You got to have a little bit more thought to it than that. But if it's just a management agreement and no one's got any skin in the game, like, hey, why not?
Yeah, but even a management agreement, I mean, good operators want a good reputation and they want to perform, right? And it's an opportunity cost if it doesn't perform. I mean, you guys both get really deep into the markets you're working in, because Gio will always say like, well, it's one thing to do a feasibility study on a market, and I do those, but like from a broad stroke, but you get down into like, which side of the highway are you on? Who are you attracting if you're on a specific side of the highway? Like the granular detail you need to understand in a market. To your point, it can be, really tricky if you're not in that market to understand what, the success factors around the location and exactly who you're going to attract, which should line up with your overall, ideal client and brand positioning. So yeah, but I mean, you see brands, Kiln is a great example. They continue to expand and they're doing one-offs in some markets. I think they also, to your point, look to do multiple, but it takes time and they do a lot of creative deal structures, but they seem to be doing pretty well as they expand.
They're also incredibly well managed, and they have
Yeah.
very
I
high
think it's
level.
strong team.
They have
Yeah.
high level people at all the right places that I'm certain they probably don't even need to hire us for feasibility studies because they do their own.
Right.
And they They fly a whole team to evaluate a market. And I learned from Gio, I used to try to broker across markets without physically going there. During COVID, it was like, come on, we can do this over the phone.
Yeah.
It's fine. But
Yep.
there is so much value in physically going to the cities. Orlando, I think, has a lot of good indicators, but there are some problem areas downtown that you need to know about if you're going to open.
Yeah.
Doesn't mean you can't overcome them. It doesn't mean that it's not going to get better. But if you just went in blind and plopped a center in a building that was on the wrong block, you might be disappointed in the results because of, lack of real market knowledge. So I think, no matter what, do your homework, do your feasibility, talk to people, talk to brokers, stay for a week, walk around, walk around at night. You really have to know what you're doing. And this is such a location specific business that being on the wrong side of the road could really make a difference. Not all operators would agree with me on that, but I think personally, if it were my money, it would be, really, really granular in terms of site selection.
It's a good thing.
I can tell you the successful ones worry about that, right? The non-successful ones are like, don't think through that. Or because again, I mean, that's such a big part of it. I tell people all the time, we're a retail business that happens to offer an office product. And I think people forget that at times, and they find a really cool building, and we've experienced it here recently in Charleston. We've experienced it in Columbus, Greensboro. These are specific markets where I know there's really cool spaces that have opened that are in the process of shutting down or not successful because they missed the mark, right? And so I think that's why people having subject matter experts that can help them have all these discussions is so vital to the success. And so I know, the two of you are doing this on multiple fronts, on multiple levels. I mean, I know, Jamie, you get down to the super granular level with landlords with RFPs and all kinds of stuff like you're currently doing
Right. But
for a couple of them. So
but I don't get into the markets like you two do. And I see people who work with brokers who do not have the background that the two of you have and do not have the commitment to success that the two of you have. And I'm so grateful that the two of you exist. And,
we do have a vested interest. We've chosen to focus on this industry, and we have a vested interest in its reputation and its track record.
Right. We're in it. We can't get out of it at this point. So
yeah. So, I think the traditional broker, of which many are my friends, there is some short-sightedness and like moving from deal to deal. Like that's just the stigma, is like, get the deal done, move on. We'll talk to you in 10 years. Well, in this environment and, this small network that we have, I think success is critical. And not only for that particular operator, but for all operators, because one failure has a ripple effect across the perception of the industry. And we went through this in the most violent way imaginable with the WeWork bankruptcy. And I think, for what it's worth, I do think WeWork's probably heading in the right direction. I don't know if I'll say Phoenix rising from the ashes, but I do think they're on the right track. And they've announced new deals. And by the way, their leases, they would of course prefer to do shared economic deals. But I think, at least from what I've learned of the recent announcements, these are traditional lease deals in good buildings in New York with landlords that have options, that have chosen to go with WeWork instead of someone else, right? Because that's what they're facing. They're looking at, do I do that? Do I do this with WeWork or do I do this with a law firm? And if there's no law firm and there's a WeWork, and WeWork has proven that they're more mature now and they're financially in a good place, I think they're going to be growing more and more. And I think what they just announced this week, that they're shutting down one location in New York and opening a new, and maybe there's a transition for those customers there, which we also know a lot about. But I think that's going to be happening as they evaluate all buildings that are still open and WeWork. Do they stay and renew? Do they even have that option? Do they replace them? And all of that's going to be happening over the next 3 years, because the bankruptcy proceeding allowed them to kick the can or to renegotiate, but landlords were, backed into a corner and had to make a decision about a very large tenant in one of their buildings that's probably challenged in other ways. So I think the future of all these WeWork sites that are open and doing well is probably still, in the next 3 to 5 years, they're all going to either renew or close. And if they close, they're going to try to open a replacement site. So there's going to be new WeWork transactions, renewals and new deals over the next 3 to 5 years that I think will be interesting for the market, because if they leave a space and they've had it for the last 10 years and they were successful in it and they're leaving for one reason or another, it could be an opportunity for someone else in the industry to step in and do something with that landlord on a partnership basis. Maybe not, but the WeWorks that are open, it's my understanding that they'd like to keep them open.
Yep.
So if there's a WeWork open in your town, it's most likely going to stay open for the foreseeable future, but there's going to be a point in time in which they have to make a real estate decision on whether they renew or they move.
Michael, I'm curious.
I
I
think-
know we're
Go ahead.
quitting time for you, but you mentioned the 20-person requirements, that want space that's kind of purpose built for them, not just, let's, distribute you across open offices. I mean, there are not a lot of operators with that type of scale. Certainly was one of them. Like, are they still serving that client with the new locations? I mean, I know some of where they got in trouble with these, big corner spaces for 50 that, post-pandemic just didn't fill, and which also make them very hard for other operators to take over because they don't have that demand. But, you get operators like Tishman who are, very equipped to produce that demand and service that demand. Do you think that supply and demand will sit with landlords, or do you think we'll see operators taking that on like a WeWork?
So the one I was thinking of when I mentioned that earlier was in San Francisco, and we did a survey of what's available. They wanted co-working space only. We looked at, are there any landlords that would consider a short-term deal
Yeah.
that could service them in the way that they want? And we ended up saying that didn't exist, at least within our time frame. So we focused on operators that had space that could work. And the only ones that did, Industrious had one site. It was slightly too small. One suite inside one of their spaces in San Francisco. Mindspace had one suite inside one of their spaces inside San Francisco. WeWork had dozens. And so where did we end up? We ended up with a great price at a WeWork in a wonderful building in the middle of town. So they are truly, in my opinion, the only ones that have scale at that size range. Industrious will have some in some markets. They've obviously moved away from that in a lot of new centers, at least at that 20 to 40 level, but they're still trying to solve for enterprise in a different way.
Right.
And I think that's going to be more of a managed service in partnership with landlords.
Yeah.
I've spoken to them about that, but it's still a gap in what operators offer and what they can offer. And I think everyone knows they're hard to fill. They're great while they're there. They're bad when they're gone. And that is what got WeWork in trouble. But if you talk to WeWork in most markets, the big markets where they are, these NFL cities, like they're probably doing pretty well in that size category. They're not doing full floors with 100-person rooms. Like that is better left to the landlord. But the space between 20 and 30 desks, I think is still an opportunity for some operators who have the scale to deliver that. Work is like their only option in certain small markets is Regus. Well, the only option in big cities for co-working at 20 desks is pretty much WeWork. And that's just the reality. And, sure, if you go to Salt Lake City, maybe Kiln has something, maybe Workbox has something, but in general, it's a one-off or WeWork that has the support for that. And the landlords like Tishman and Hines, they have their private suites. And I think we talk about this all the time, but London is slightly more advanced than the US in terms of landlords providing service suites, so that space between spec suites and traditional leasing and co-working is not yet been solved. And I know a lot of people are trying to figure that out. I know we spend a lot of time at Core trying to figure that out. The economics are hard to make work at scale.
Yeah.
So you have to kind of own the real estate to do it.
Yeah. And I think part of, and this will be a good ending place because I know we're over, but I mean, WeWork, you got to remember, has hired someone that's been in the industry from a commercial real estate standpoint a long time, right? He's not your typical co-working hire. And, if we're being honest, the hire took a lot of us by surprise. But I think that John Santora's showed up and really set the tone and created some stability, right? Making it, cutting all the fat and making it more profitable. I mean, they say they are profitable at this point. I mean, I haven't really looked at the numbers, but regardless, they're doing better than they have in the past. And so I'm really excited to hear him speak and kind of hear I've seen and read a lot of his stuff, but I'll be real curious to hear what his take is. But he's got a lot of those corporate enterprise relationships directly with the corporations, but he also has them with a lot of those brokers that are making those decisions on behalf of those enterprises. So I think it'll be interesting to continue to see them evolve. I think it'll be interesting to continue to see, Jamie in his new role kind of running that whole project, or we'll call it, more of a building management, hospitality services arm of CBRE, and see how that continues to evolve as well.
I'm excited. I'm glad you said that because I'm excited to see WeWork do well too. I think the industry, fairly or not, it was kind of reveling in their struggles a little bit because they came in, made a huge splash, put people out of business. There's scar tissue around the industry with respect to WeWork, but I do think that they're likely here to stay and they're going to be a real player and should be taken seriously by the industry. I think we've had some participation from WeWork and GWA locally in DC. That's been fun. Like Dave Belford is a friend, and I'm really excited. They've been successful locally now that they've right-sized their platform. So I hope they do well. I eagerly await the day that they can share the fact that they're profitable and provide the receipts. But those, and you mentioned Jamie Hodari and Industrious. I think that partnership is really going to shape how CBRE goes forward with property management. It's going to shape how they think about their occupier journey and the portfolio strategies. And we can maybe close where we started, and that's that occupier sentiment survey. And they do have 4 pages on Flex, and it's fairly positive. So talking to the biggest the biggest occupiers in the world down to mid-sized companies, and they're all already participating for the most part in Flex, and they're looking to expand that participation over the next couple of years. So we can take that as a positive for the industry, that occupiers are taking the space seriously and are looking to introduce that into their portfolios if it's not already.
All right, Jamie, you got to come up with another question because your dance question or your singing question is not attained here today.
Okay, this one's less fun, but Michael, what are you using AI for?
Travel planning.
I like
So-
it. Where's your next trip or your most recent trip? What trip did you
The
use?
most recent ChatGPT I have with respect to travel is Scotland over the New Year's.
Ooh.
So Edinburgh has a really big New Year's celebration, and picking the right hotel, and then when you have limited time over that tricky period, things are going to be closed on the 1st. That's a travel day. So where can we go that doesn't have a minimum stay, that will be open, that isn't in the middle of nowhere, that if we can't find dinner, there's a good hotel restaurant. It's like you can nuance the prompts to a really, really granular level that makes me really happy because I'm the travel planner. And so I trust that the accuracy of that recommendation is going to be better than what I would normally find on my own, and it would certainly be quicker.
After hours of searching.
So that's a fun thing. I occasionally I'll treat it like Google, which I know is the lazy, people that are advanced in AI would say that's that's not a good use of AI, but I think it's still helpful. But where I found a lot of value is in travel planning, because that's something that we do a lot of, and the responsibilities for picking places falls on me.
Better be good.
Yes.
I like it.
So
No pressure.
that's fun.
Okay, Gio, we look forward to a debrief on your gallivanting around the world on the next episode. Safe travels.
Yeah, no, I appreciate it. Thanks for joining us, guys.
Yes, thank you, Michael.
Thanks for having
Thanks,
me.
Miguel.